Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan. Delighted to be with you once again today. And we are going to delve into this pertinent topic of cost segregation and look into the details and find out how we can use cost segregation to hedge against inflation and to increase our cash flow. Bill Smith is the National Sales Director for ELB Consulting. He works with commercial real estate developers, owners, and investors to reduce their federal tax burden and increase their cash flow. After spending 20 years in executive sales, marketing, and management positions for both Fortune 500 and entrepreneurial firms in real estate finance, technology, and services, Bill teamed with ELB in 2013, turning his considerable experience into the specialty tax solutions business. So welcome, Bill. And
thank you for having me.
You bet. So start us off and just share a memorable experience from your formative years that may have helped you to be who you are today.
Wow, I didn't anticipate this question. Well, I've had so many formative experiences and working with folks and having mentors in my early career and spending, like you, many years traveling on planes weekly. That just trained me in so many things, and mostly in client relations and service and development. I spent my college years in the restaurant business and thought I would be a restaurateur at one time. But fortunately, I had a client rescue me out of that and get me into the mortgage finance business when I graduated. And I've not looked back since. So I've worked for some of the largest companies out there in that industry. And so I've had great relationships with the chairman of First American Title Company. I know him well when I was with First American. So, just having those relationships, I think, is important. And so any specific experience, gosh, there's so many that help me, but mostly it's really in the service and support industry and taking that into cost seg because people don't understand. They need education on it. They want to look how this can benefit them. So my role and what I do with the OB is to essentially focus on, is it going to help you? How's it going to help you? Are you a real estate professional? How do you use the deductions? Can you use the deductions? Some people say, well, no, sometimes they say, well, straight lines are going to get you covered. You don't need this, so I kind of unsell sometimes and they go, wow, that's really great. And they, then they come back later when they get those things. So that, from a background perspective, I think mostly is just being focused on client service and support and making sure that needs are met. And ELB is very focused on that. So I've been with them for 9+ years and don't plan on ever doing anything else.
Well, Bill, we shared background in restaurant businesses, and I, like you, am glad that's behind me.
Yes. I like going out but I get a nice meal, but I'm particular and I love to cook. I'm kind of a foodie, but yeah.
It's an all-consuming business for sure.
Yeah.
Bill, take us into cost segregation and talk to us about using it as an IRS tax liability deferment and how it is that different investors use it in different ways.
All right. Well, as I'm sure your audience is aware, or at least has the fundamentals, what cost segregation primarily is the reclassification of specific assets in your building to a shorter life. So when you bring from a long life to a shorter life, you move those deductions, you front load those deductions. So essentially you're deferring your tax liability. It's just, you're going to have a tax liability. You're going to pay the IRS at some point, but cost segregation and these deductions let you defer that. So most of my clients are buying properties, multiple properties per year and annually. So many want to do a 1031 because that's the best way to avoid taxes, but not necessarily, because you can get locked into that. And for the right reasons, that's a good strategy, but it's not the only strategy. And cost segregation generally acts the same way. And if you're active, then you want to do that. If you're a onesie twosie and you're not going to do stuff, maybe a 1031's right. You're doing legacy stuff or you're handing down your kids, the step up in basis, we start talking about taking that away. Who knows if tax code will be passed. So really, that's what it is. It's just creating deductions to offset your tax liability. I'm sure most of your listeners here on this audience might be real estate professionals or using the short-term rental loophole to then use that, depreciation to offset ordinary income, W-2 income, capital gains, whatever. And so that That's the linchpin for commercial real estate. That's why people do this. I mean, commercial real estate's a great investment, but the depreciation is a huge thing. And our former president, they were attacking him for not paying taxes. I have no idea. He has a little controversial figure, but I would imagine we've done plenty of big casinos and things like he owns and resort hotels. And I bet he didn't pay taxes because he had depreciation. That's the tax code. So a lot of people do it. So that's the key, is taking these deductions up front. It reduces your long-term straight line, but you still have straight line time depreciation, but you'll reduce those up front to take advantage of deductions. That's almost like having a big itemized deduction. I mean, $100,000 in depreciation could offset your income by $100,000, as a deduction.
Bill, you mentioned here long-term straight line deduction as opposed to the cost segregation. What is that?
So let's say you bought a multifamily for $27.5 million, and we'll just assume there's no land. So that's your depreciable basis. So, or 27,000, maybe whatever. You would divide that by 27.5, and that would be your depreciation. So you'd have $1 million a year if it's 27 million. So what we would do is say, let's take a look at that. And on a multifamily, we might find 30, sometimes upwards of 40+%, depending on the features and functions and what I call, kind of a silly name, but I use it anyway, building blank. Is there crown molding? Is there wainscoting? Is all these other things and wall coverings and flooring, and they all make a difference. Specialty lighting, window treatments. So when you take those, and let's say we take, I don't know the math, but let's say we find 30%. And so now you've got 70% of 27.5 million is still straight line. So it reduces that division from 10 million a year, or million a year, I'm sorry, to, several thousand. But all that 30% can go in year one with bonus depreciation, which I'm sure everybody's familiar with. Bonus doesn't mean you get extra, which I think is a misperception. Like, I get 100% bonus. So if my depreciation is 100,000, now I get 200,000. No, that's not what it means. It means that 5-year, 7-year, and 15-year life, anything less than 20 years, you can elect, it's an option, to take it in year one. And pretty much everybody is doing it. Even in that case, let's say you get 10 million in depreciation. I don't need 10 million this year. 5 million is fine, or 4 million is fine. Well, you don't lose it. You take the 4 million, offset your income, and that 6 million carries forward to next year. It's a NOL, carry forward, suspended loss, whatever, your accounting method would call it. So you don't lose it. And then of course, most people might, if it's a syndicator or it goes to investors, a JV, fortunately it's split up. If it's 10 million, you got 4 investors at 25%, they all get 2.5 million in benefit. So it all works that way. And it's a pass through, obviously, as you know. So does that answer your question?
Yes, sir. Thank you, Bill. And how does this work as a hedge against inflation?
Well, with, the economic conditions going on right now, we do a team meeting and someone, I write blogs for our website. If you go to our website, you can see that. And one of the most recent one was that it can be a hedge against inflation, because inflation is a big topic, as they would say, a kitchen table topic, right? And gas is up, groceries are up, everything's going up. So we look at $1 today is worth more than $1 tomorrow, right? Everybody's saying that. Cash is king. So if you take the deductions today in today's dollar, so that let's say it's a $10 million property and we find 35% on a multifamily, that $3.5 million is taken today as a deduction in today's dollars. So versus what you might have in the future. But we always do look back studies. If you bought the property several years ago, didn't know about it, now learned about it, you can still do cost segregation. You've taken straight line for several years. Now you need to tell the IRS, I'm changing my accounting method through the change of accounting method form called the 3115 to then be straight line. And that form reconciles to be component level depreciation, reconciles the previous, how much you would have taken in those 3 or 4 years to today's dollars. And that's what that form does. It's automatic approval of the IRS, goes to your tax form. No big deal. We do that all the time. But the big thing is the 100%, which expires this year, but then it goes to 80 and 60 and 40, then 20 over the next few years. And the tax code changes that have been proposed don't seem to be taking that away. So for 20 years, we've been doing cost seg, we didn't have 100% bonus. Occasionally there was 50%. So that's a good thing. And what people may not know is in the past, until the Tax Cuts Jobs Act that went into effect September 28th was the effective date, 2017, it was only valid for new construction and new construction improvements. The tax law at that point made it available to acquisitions for bonus depreciation. So that's why we did this huge surge in folks learning about it, investing in real estate like your audience here, and building a portfolio to escape from corporate W-2 jobs and become real estate tycoons.
Bill, you also mentioned that cost segregation is helpful in risk management and particularly in economic downturns. How is that a risk management tool?
Well, there's several ways in which it can be. So first, I'll take it just from the straight building. So when you do a cost segregation study, we allocate a value to every component, the roof, HVAC, the walls, the windows, every single thing is isolated and calculated out. So for example, hurricane season's coming up. People are in hurricane or tornado alley. There's huge damage to their buildings. Their roof is ripped off. Well, insurance is going to pay for that roof that's ripped off, right? You get, $500,000 to replace that roof. However, on our cost seg study, we might have identified, there still might be $250,000 worth of life on that roof that you had because it was still a decent roof. Most people just put the new roof on, insurance pay for it. They take the old roof off, put it in a dumpster, it goes to the landfill. Fine. However, that's a $250,000 expense you can expense. And at let's say a 20% tax rate, that's, $50,000 in cash you just threw away. Then if you put the new roof on, you can't capitalize with the insurance paid. You've got what they call ghost assets. And if you paid for a new roof, the same thing. So from a risk management perspective, if insurance tries to shortchange you, right, they usually don't do it. We can help you with that. And we had one example in Pennsylvania. One of our guys did a big, long warehouse and a tornado came through and actually literally ripped right in the middle of the building. It almost literally tore the building in half. And the client had called us and said, thank you so much for your study because all that asset and cost detail helped us in our insurance recovery. So in that way, it's a risk mitigation tool just because you have those details to protect yourself if disaster comes up, fire or whatever like that. Now, the other thing in today's market, we've had this exuberance, certain markets are going like crazy. So we're seeing a real rise in the value of properties. Many think we're going to see an adjustment, certainly in some markets. So if you bought a property for $1 million that it costs, say, you get $300,000 deduction. So now your basis is down at $700,000 because when you take those deductions, it also reduces your basis on your bank. So then there's an economic switch. We lose 30% value. Now that owner, had $1 million property, they're like, wow, I had expected to go to $1.5 million. And now if they have to escape or sell that property, their depreciable basis is now $700,000 or less with the deductions, not $1 million. So they can actually save that money. If there's a downturn, it can be a protection against huge losses and perhaps keeping that property versus actually having to liquidate that at a huge loss. So that's one thing. So you won't get that loss because the depreciation reduces your basis. Even if you have to sell it, then you will not, from your basis perspective, not show a huge loss. And so that's another aspect that reduction in basis can save if there's a economic downturn that impacts the value of your property and you need to make a change in the future. Does that make sense?
Well, Bill, I'm a little confused on both the insurance as well as the basis, how reducing the basis is actually going to help us in terms of keeping the property or if we're selling the property. I'm not really following you on that.
So yeah, it is confusing. It's highly technical and that's not why people really do it, but it is there as kind of a backstop. Should you buy a property for $1 million, we depreciate 30%, that's $300,000. So when you take that homestead bonus depreciation in that first year, now your basis is not $1 million, your basis is $700,000. And let's say, and then you're in your straight line for the next years. And then let's say there's a market adjustment and now your property's not worth the $1 million that you paid for it. It's worth, $800,000 or $700,000. So if you had to liquidate that or sell that, your basis, you've protected yourself in that basis is now you're taking a loss, but you're not taking a loss for you because your basis is adjusted. So that's one of the base appreciation does. People don't recognize that when you take that deduction, it's a basis reduction. So again, it also speaks to recapture. Same thing. Okay, now that $1 million property reduced it by 30% to $700,000 and it sells for $1.5 million. You say, hey, it's opportunistic. I'm going to make $500,000. Your capital gains, your straight capital gains is on that $500,000, but that $300,000 that you've depreciated, which reduces your basis, is also part of your capital gains. It's taxed at different rates and it gets pretty convoluted how it's done. So your capital gain is really $800,000 in that example. And so another reason where cost segregation can help. As long as you continue to do that and you're selling properties and making money, your next cost segregation study can offset that capital gain. I mean, maybe you're familiar with that. So it works in both ways, but people get scared of recapture. And if you're doing onesie twosies, then yeah, it could be a challenge. But if you're an active real estate investor, even if you're holding it for, a couple of years, again, you're taking advantage of that money. You're not paying the IRS, let's say $100,000 from the deductions, and it's your tax bracket, let's say it's 37%. That's $37,000 cash in your pocket that you keep, that you can invest in your next property. So that's kind of how it works. Kind of whether it moves up or moves down, it, reduces your tax liability and could, under the right circumstances, and a downward turn on the property value save you from taking a $300,000 loss to break it even.
Okay.
That's kind of cost saving 401. Yeah. That's not all senior stuff. So we usually don't get into that level of detail, but everybody talks about the standard stuff. So I kind of wanted to give a little different information, how it can be a protection tool. If anyone wants to talk about it in more detail, they can certainly reach out after this is posted.
Yeah, my head is kind of spinning. Good hearts to this. It is good to know, though, that there are different means of looking at cost segregation and ways and means that you can utilize it that are not as straightforward. Well, I don't think there's nothing about cost segregation that's straightforward for me, but the ways and means that you have pointed out here are things that I have never thought of or considered, and that could turn out to be very valuable. And I guess the one thing that I'm really beginning to understand, Bill, here is that the cost segregation really does give us a lot of flexibility that certainly straight line depreciation does not. If we're going to take straight line depreciation, we have to take that each and every year in accordance to what that straight line has been indicated from the beginning. But cost segregation, we can take it all in one lump sum. We can spread it out. We can take it this year and maybe not take it the next year, depending on what our income is. Is that correct?
No, not really.
Okay.
So bonus depreciation is an election. So when we do a study and we identify 5 and 7 year property in a multifamily or a hotel or whatever it might be, warehouse, flex, house, Airbnbs on the beach, I do a lot of those. And then we'll use the 30% example in the, just for simple math. You can take that, that 30%, let's say 20% of that, 200,000 of that million is 5 year and 7 year, and 10% is, other 100,000 is 15 year. When you don't have to take bonus is an election. When you input your CPA, puts on your Schedule D, your depreciation, I'll only give the IRS and never send them a study. They don't need more information. Just answer the question. Just like a lawyer says, never answer a question you're not asked, right? So you put that in there and you can say elect, and the 5 and 7 is actually what's called 245 property. It's personal property. And the 15 year is still 1250, like straight line. You can take just the 15 year or just the 5 and 7, or you can take them all. But once you take it, you've got to take it. And then your straight line is reduced by 30% of what it would have been. It was going to be 10,000 per year. Now it's going to be, 7,000 per year. So you still have that straight line ongoing, but you can't just, I can use it this year, not use it next year. It carries forward. Now, if you don't need it, then say you don't need it next year, but you taken 300,000, you scooped 100,000 out of that bucket for this year, that 200,000 carries forward. Next year, you don't need it. It still carries forward for 19 years. So you never lose it. So it's always good to do your study in the year you go in service to establish your depreciation schedule. And since bonus depreciation has occurred, I've had a few clients, 3, I think, that elected not to take bonus because the depreciation was so good for their tax strategy. Because I always had a tax strategy. That's why when I talk to folks, it's like, what are your needs? What are your goals? What makes sense? And let me see how I can help you. And then talk to your CPA, because your CPA knows your return. I mean, every return is different, but you may not need to take it for certain tax strategy reasons, but for most part, people are taking it, especially if they've got investors, and investors now are investing in passive and stuff so they can get depreciation. A lot of my clients, they say, my investors need, depreciation. Looking at, I've been hitting 100% for those. The guy puts in 100,000 in a syndication. He's got to get a first year K1 loss about 100,000. So right there, that's a 1-to-1 ratio. And my clients love us for that. Again, because of our forensic level of detail and being a fully engineered level 1 study, there's 6 levels of study first two are basically the same, whether it's new construction or a purchase price acquisition. But most others use more modeling and residual and other methods, and they're good and they support it, but they do miss some things, especially in the electrical distribution system. So MEP is where we really shine, and that's where a lot is. So we tend to, without bragging, find, 6 to 15% more than others. So the benefit is there. So again, having that forensic level engineering and allocating a cost to every single component, again, that's part of the insurance benefit, hedge benefit. If there's disaster, if something happens bad, it can prove to be beneficial. It may not, but it has that ability, as I said before. It is kind of confusing. One of our guys is super technical, that stuff, and he goes through that. So I never even thought about that myself. I'm like, that's a good point. That really makes sense. So we don't sell it that way, but it is good information to know should it be necessary for your tax situation.
Bill, our viewers and listeners would like to get in touch with you, I'm sure. So how get in touch with you and what do you have to offer?
So, my email address, I think you're going to post on there, is bill@ELB Our website is elbcostseg.com. It's elbcostseg.com. My cell phone, you can post that on there. I'm not too concerned about that. I just don't want calls, for DirecTV trying to upgrade me or something like that. And that's 480-747-5547. And while that's an Arizona number, I do reside in the East Coast in Richmond, Virginia. And what we offer, when someone says, gosh, I want to learn more about this, I like to talk to them, understand their situation, get the details on their property, and we prepare what we call a tax benefit analysis. It's really a proposal. But we say conservatively and optimistically, what are you likely to get? We research every property, give a range. We don't know until we get in what we're going to find. Sometimes things are different. This big shopping center, we go, oh yeah, we do all your benefits from this. We get out to the property and it's still a shell. They haven't built out all the, it's like, well, the benefits in the building, the shell, for cost segregation, for the straight line, you need walls, windows, doors, roof, HVAC for human comfort. Bathrooms. Other things aren't as much as necessary. Specialty flooring, wall covering, specialty lighting. You need general lighting, but you have like can lights, pin lights, arc lights, recessed ceilings, drop ceilings. People do very nice interior stuff for some offices, and doctors' offices are great. All the rooms, all the built-in cabinets, doctors' offices perform very well. Medical offices and medical facilities. And also because of all the electrical and plumbing and things, the specialty services, restaurants, Starbucks, things like that, they kill it. Because you got a small shell, but everything else is kind of specialty. So it's not necessary for human, habitation. And HVAC, if you've got a computer room or a clean room or a data center, something like that, that HVAC can be short life. Normally HVAC is 39 years, 27 straight line, but 27, most real estate's not going to have that. But in specialty commercial properties, if you've got HVAC supporting a special purpose, then you can short life. And I've had CPAs go, well, I've been doing this for 30 years and HVAC is 7 years because they have to replace it every 7 years. It's like, no, it's not. It's straight line. He goes, when did they change that? Like, never, So CPAs are really good. And I don't want to, but that's why you use a cost like professional. So we work with a lot of CPAs that say, oh, okay, we're like the specialists. CPAs like your general practitioner doctor. Go and get your checkup, do some things, take a blood test, whatever. They tell you what's going on. They say, I found a lump. Guys, I was like, you need to go see somebody. Well, we're that somebody that says, okay, we're the heart surgeon or the brain surgeon. It's like, this is what we do. We focus just on this and a number of other tax specialties, but really this is kind of our niche. And so we support many, many CPAs across the country. When they have a need, they rely on us. And same with any of my competitors, they all work with CPAs. So it's not really the only one.
Bill, it's a wonderful tool for sure for many real estate investors. And there's still a lot of people in the commercial real estate investing industry who don't even know what cost segregation is, but many, many do. The aspect of this that I find interesting is that you say that it can be beneficial for single family rentals, which is really quite surprising for me because the detail that particularly, there are cost segregationists out there, like you have already mentioned, that really, they tell you, they give you the whole banana, but they really aren't doing that. And they have reasonable pricing. I don't understand how you could really make this cost effective for a single family home if you're going to go in and do that level of detail that you're talking about. How do you manage that?
So there are two ways. So if it's I've got a client now that told his company for $4 billion or something. So he's making his CPA gets me, and he sent me I got some residentials that I need to do. So okay, so I figured, they're like 20 million. Oh, he's multifamily. No, these are homes. We go, So in that case, it's such a big home, that's his rental homes. We'll do a full study, which might be $6,000-7,000. So, I mean, it's really pretty affordable for that. But for smaller homes, under 100,000 or 500,000 or $1 million, I mean, because we've been doing this for 20 years, about 5 years ago, we started developing a platform we call DIY Cost Seg. So people might know about that. That's the ELB's division, the ELB spun out and did that. And that's an online modeling system, which most of our competitors use a modeling and go out and take a few pictures. It's a non-inspection product. It's inexpensive. It's quick. I actually did 3 of them with the client this morning for vacation homes in North Georgia and Seaverville, which is like near Dollywood, Tennessee, where we go in, input the data, and we model it. I see we're running out of time here, and we do a cost seg. And so for under $750,000 in basis, it's $640. And we give an asset detail. We model it based on our 14,000 studies of experience. And then we provide that study and we fully defend it. We provide audit defense in the event the IRS ever comes calling. And, up until about a year ago, we had done, maybe my fingers and toes could cover all the audits and 15,000 studies that we had to get involved in. I mean, some of them, they just send our study and it's like, boom, check, no change necessary. That's what the IRS says. It's never triggered. Depreciate's never triggered the audit, something else in the return. And while they're in there, like they look at everything. But we've seen more of research. Maybe the new administration, one of their avenues is to just go after and audit people. And so we've had audits on our DIY model. It's a model, non-inspection product. We use 4-page report versus the 80, 60, 100 and some page report, depending on the property. But we give asset detail, asset breakdown, and we pass the flying colors. Haven't had to go out. Now, our defense means if the IRS is asking, well, how did you price that outlet in the toaster it's plugged into in the thing? Because, the outlet, you say, at Home Depot, it's $4.99, right? Well, no, it's not. When we cost it, we use RS means, which is like insurance adjusters and estimators use. Sure, it's that. But then there's the installation, there's all those kind of costs. So it might actually cost that to be $24.32 or something like that. So looking at those electrical components and the breakers that support them, if we needed to go out and do that, we would provide that $5,000 study on a rental home to support it, but we haven't had to do that. So we do defend this modeling system. So it makes it for smaller properties much more affordable, and we get great results. I mean, I've did it on condos. I've done Airbnb, a lot of Airbnb. Everybody's getting the short-term rental business, do a ton of those. And then single-family rentals. I've had people with portfolios of a couple hundred. I had a guy do like 48 properties a couple of months ago, getting ready. So it's well worth it and justifiable. But when someone calls and they might want a DIY, and I look at the house and it's like $1.5 million, then we look at, okay, well, here's what you're going to get. Let's say 30%. If we do a study, we might get 35 to 40% if we really go out there because of the landscaping, all the details that we can't account for. Specialty features in that home. I said, for 5,000 more, you're going to maybe realize on $1 million, that's $1.5 million is the depreciable basis. Let's say we just get 5% more. That's so spending 5,000 to get 75,000 more depreciation. If their goal is to maximize depreciation because they're a real estate professional, is worth it. So I always counsel it. What are your goals? What are your needs? Does it make sense to do this? I've had some small doctor's offices, but a lot of the reasons we do it is just because we're so busy. We want to take some of the pressure off just our engineers and things doing the studies, and it really meets the needs. And it does it for single family homes. It does it for self-storage, hotels, restaurants, retail, flex, warehouse. We asked if it's a warehouse, how much is it conditioned? Is it conditioned for just, heat or AC? How much office space is there? And I've got something we can dismiss this. It probably didn't show up on there. I've got something as well coming up. But so really that tool, and if it's a commercial property, it's going to be anywhere from $1,400 to $2,500, depending on the basis. We go up to $3 million on that modeling system. So I've had people, I had a $2.8 million Airbnb in Beverly Hills. I said, you need a full study. He goes, nope, we ran the number. It was 880,000. He goes, I'm good. I'm like, okay. He would have got probably over $1 million if he had done that, but he didn't need it. And he said he was good. So in that case, I would have probably suggested a full study, but he didn't need it. So
enlightened investors, I know you found today's program enlightening and informative. It's been a pleasure being with you. I look forward to seeing you in our next episode. Bill, it's been very good having you today. Thanks for being with us.
Oh, I appreciate it. I really appreciate it. And hope that if anyone wants to reach out, you'll have my information in the show notes. Thank you.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.